In this video, we're going to be performing a deep dive on Dominion Energy's dividend safety. To begin, let's talk about Dominion Energy's business model. Dominion Energy is a large electric utility that is headquartered in Richmond. Dominion Energy is valued at $47 billion and has more than 6 million customers in 8 states. In addition to electricity services, Dominion Energy also operates in some other industries. For example, the company recently started its Cove Point LNG project. Dominion Energy is a well-known dividend stock because of its excellent combination of yield and growth. The company currently trades with a dividend yield of 4.6% and has increased its dividend for 9 consecutive years. This means that Dominion Energy is just 1 year shy of being included in the Dividend Achievers Index, a group of stocks with more than 10 years of consecutive dividend increases. Looking ahead, Dominion Energy's high dividend yield has led many investors to question the safety of its future dividend payments. For the remainder of this video, we will discuss the company's current dividend safety from 4 perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, its dividend safety in the context of its recession performance, and its dividend safety in the context of its current debt load. First, let's discuss Dominion Energy's dividend safety in the context of the company's current earnings. When Dominion Energy reported third quarter financial results on November 1st, the company announced that it generated earnings per share of $1.30 in the 3-month reporting period. For context, Dominion Energy paid 83.5 cents of dividends during the same time period for a payout ratio of just 64%. Looking out over a longer time horizon, our conclusion is the same. Dominion Energy's most recent financial guidance calls for 2018 earnings per share of $4.02 at the midpoint, and the company is on pace to pay $3.34 of per share dividends during the same time period for a payout ratio of 83%. Using earnings, Dominion Energy's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. Accordingly, we will now compare Dominion Energy's current dividend payment to its free cash flow. Through the first 9 months of fiscal 2018, Dominion Energy generated $3.7 billion of cash from operating activities and spent $3.1 billion on capital expenditures for free cash flow of around $600 million. The company spent $1.6 billion on common share dividends during the same time period for a free cash flow dividend payout ratio above 100%. This is an alarming observation. It appears that Dominion Energy made up for this cash shortfall by issuing an additional $1.2 billion of debt, net of repayments. While Dominion Energy's inability to cover its dividend payments with free cash flow may be due to a temporary period of increased investment, we recommend that current and prospective investors monitor this trend closely moving forward. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. With that in mind, this section will analyze Dominion Energy's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by measuring its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Dominion Energy's performance during this time period is shown here. Dominion Energy's earnings per share actually increased from their 2007 level through the global financial crisis. Because of this, we have no concerns about the company's ability to pay rising dividends during future economic downturns. The last angle that we will use to assess Dominion Energy's current dividend safety is by looking at the company's current debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before its net income will no longer cover its dividend payment. Through the first 9 months of fiscal 2018, Dominion Energy generated $1.1 billion of interest expense and had $30.2 billion of debt outstanding for a weighted average interest rate of 4.9%. The following image shows how changes to Dominion Energy's weighted average interest rate would impact the company's dividend coverage as measured by free cash flow. As the image shows, Dominion Energy's weighted average interest rate would only need to rise to approximately the 6% level before its dividend would no longer be covered by net income. This is a much smaller margin of safety than what is common among the other stocks we've investigated in this dividend safety analysis series. It is particularly troubling when combined with our earlier observation that Dominion Energy's free cash flow has not recently covered its dividend. With that in mind, we recommend that any current or prospective investors in Dominion Energy monitor its future financial performance closely to avoid experiencing a dividend cut. Thank you for watching today's video, which performed a deep dive on Dominion Energy's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover SureDividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.